to speak about I guess I want to kind of discuss about being investors, right? So the capital stack, there are different kind of types of investors involved in a real estate deal. The bank is in a way an investor. They sit at the bottom of the capital stack. They have certain their risk is it's about the risk that exists. So they sit at the bottom of the capital stack. The bank does. They're the senior debt, and any kind of income the asset makes has to go to your senior debt first. But right after or right next to the senior debt is, in some cases, is something called pref equity. And these are equity investors who come on board. They're not bridge lenders. They're not mezz debt, but they're investors in a deal that have to hit a certain return before anyone else in the deal, including the limited partners or the GP, gets any kind of profits. And then the next line after that is the common equity, which is the limited partners, and then next is the GP. Have you ever thought about that type of investing in deals for you to sit on that pref equity stage, and where you just get in most cases you just get a preferred return rather than participating in the upside? Or kind of talk to us about any experience if you have.
Yeah. Do you guys offer pref equity in your deals or no?
We do. So we're currently on a large deal that we're looking at, but the pref equity, you have to, the way that our underwriter explained it to us in our modeling is that let's say we're doing a $20 million raise. Even if we have an ability to raise the $20 million from the pref equity, or a big percentage of it, the issue will be that the rest of the investors might not hit that preferred return you're trying to hit them, because most of your cash flow is going to feed the preferred equity portion. And excuse me if I'm kind of using the wrong terminology. So a portion of we are looking to possibly make available a portion of our investment as pref equity for pref equity investors who come on board.
We do the math and allocate a certain
amount so come on board. Like for currently on our deal is a $27 million raise, and we on our current model we've allocated $7 million on the pref equity tier for investors to be able to invest in that, but a minimum investment of $1 million, for example.
Okay, got it. So there's a lot to cover on this topic. I think it's a very important topic. And my biggest concern with this topic, to be told honest, and I was just on another podcast yesterday actually talking about that too, is that I really don't believe that investors fully understand that when they invest in preferred equity or common equity, I don't know if they understand the capital stack and the risks or whatever that you're talking about right now. And I think it's really, really important for them to understand. So I have invested in a couple of pref equity deals. I generally don't. And I can explain to you why, but the ones I've done have been highly unique, unusual, and not what you guys are looking at right now, in that I'm always honest. So I'm going to be honest again. My opinion is that pref equity has popped up in the last 2 or 3 years, because really, if you were investing in the US in 2012, you wouldn't find pref equity typically in an apartment deal. But it's popped up in the apartment deals recently as a result of the lower cap rates, meaning that the cash flows are lower. In order to be attractive enough for some investors to want to participate in terms of the cash flow. And so the pref equity can be a really good solution for someone who's looking for cash flow, but there's a lot to consider too. So I 100% agree with you. The common equity holders are more at risk when there's preferred equity. And that's actually one of the reasons why I don't invest in preferred equity deals normally, because I prefer to be in the common equity just for myself. Everyone's different there, because when you go and explain it to your investors, like there's pros and cons to being in each. So, it doesn't, just because I only do common equity doesn't mean it doesn't make that may be the opposite for somebody else, right? So, but I don't like the concept of being behind more preferred equity, because when I go into a deal, I look at the loan to value of the bank that we talked about, and I'm trying to target 65 to 70% just for my own comfort level. Everyone's different. And then if you put preferred equity ahead of me, now it's not really 65 to 70% anymore. There's more people ahead of me, right? I'm not getting my pro rata share, to your point. And so I have more risk as a common equity holder when there's preferred equity holders ahead of me. Am I going to get compensated? Is there anything in the deal that's making that make sense versus a deal that doesn't have preferred equity for me on the similar building somewhere else, right? So that's a big concern for me personally.
That's your view as a passive common equity investor.
Yes.
When you're coming into a deal, and if you see a pref equity investor involved, then you say, hey, is this gonna trickle down to me? Is this kind of waterfall is gonna eventually hit me, or are these guys now have promised a pref equity return to certain investors, and us common equity folk are not going to be able to get any of the pref return or cash flow coming to us.
Right. And so sometimes what results is that if you think about it, every time they're giving up a portion of units in preferred equity, they're not participating in the back end profit. So as a common equity holder, what I can do is maybe get a total higher return because there's less equity that's being diluted into the deal. But I don't invest for that. I invest for cash flow. And so I don't want someone to be ahead of me on the cash flow. I don't care if I get the higher back end. That's not what I'm looking for, right? I mean, it's great, but it's not my personal goal. So it's important to understand, and I'm glad you brought it up because that's why it's challenging for me. There's a lot of things I could talk about on this topic. I look at it as a common equity shareholder, almost like a cumulative loan to value ahead of me, right? So it's like almost like you get a second position loan, but it's not there. You just have a preferred equity stakeholder. So part of the problem in some way, the way these deals are being structured, to your point, is they're taking a lot of preferred equity. And when they take too much, I've seen some deals that would have made the effective cumulative loan to value of 75% loan, right? Loan to value, actual first position loan, another 13% of preferred equity. And I'm literally like 88% loan to value trying to get paid behind them on a cash flow, like equivalent, right? So to speak, in the way that I see it. It's not true, but it's the way that I see it. And so that if I can't get so much more return on the back end, like something's got to basically make up for it, and it usually doesn't, from my perspective, for the common equity holder. So that's an important consideration. The reason why I don't typically invest in preferred equity on that stack is because I typically target stuff that's really stabilized.
That's perfectly that's cash flow right there. You're not even caring about the back end.
Yes.
My understanding of a pref equity investor is the person that just cares about cash once right after the senior debt. So it's, in my mind there's a lot of people, and sorry to quickly interrupt you here, but a lot of people here in Canada do private lending, like being a bridge lender or a mezzanine lender as an individual who'd partner with intermediaries like mortgage brokers to do private lending. So I'm like, hey, and they're happy with it with a 7%, depending on the risk. But I'm like, hey, this would be a perfect product when you're investing in a large $50 million asset, when you're sitting right after the senior debt and you're getting the great returns that we can offer in the US, the 9, 8+%. So kind of talk to us about, as a cash flow passive investor, why is it that you're not as excited about being on the pref, as you were saying?
So, well, actually, I do hard money lending myself. So the hard money lending in the US is essentially when you're lending on like a flip of a home or other types of lending, but that's what I do. And then I'm actually the first position loan, right? But typically I'm in at a very low loan to value. It's going to be 50, 60, 70%, and I'm making 10% interest, right? So that's a different story, because it doesn't mean I'm going to put all those eggs in one basket, even if it's a really good return, right? So, and by the way, there's all kinds of risks associated with that that's not associated with apartments. So it's just totally different. But I only mention it because I do hard money lending as well, just so you're aware. So I'm familiar with that. But on the preferred equity side, you would think it'd be the perfect fit for me, to your point. But where I have issue with it is that I'm already investing in a really low risk type of profile deal, which is already stabilized, could even be 100% occupied, right? So if I'm going to get this fixed return, but I'm not going to be able to benefit from the upside and the mortgage pay down and some assumed depreciation in the back end, I feel like I'm not really getting the full return I can get because I'm going in for a similar risk profile, right? But if I can get all common equity in a deal and have no preferred equity in it, and it's already low risk, then I'm going to get probably a similar cash flow, maybe slightly lower to the preferred equity, but not that much lower. But I'll get potentially the back end at the back, right? So I guess my reasoning is that the difference between how much I'll make as a preferred equity investor and the common equity isn't great enough to make up for the potential profit in the back end down the road. Okay, even though I'm a cash flow investor, I just don't like getting that fixed return. I feel like my return, I feel like the operator is getting more of the return, and the other common equity is where I should be because it's already low risk. I don't need to be even more low risk than it is as far as my comfort level. So it's a risk reward equation for me, which the next person may completely disagree with because it's very subjective. You know?
Yes. So now let me twist it on you a bit. What if you had an option in a deal to be common equity and pref equity to kind of invest in both in the same deal? Is that something that because there are options out there? Are options?
Well, actually,
options we were looking at to
yeah, well, now that you mention it, I mean, I guess theoretically, if they're willing to take you, if there are two classes of shares, you can, as an investor, you can just do one unit of each, right? So that's actually interesting. I never thought about that. I'd have to run the numbers. I've actually, to be fair, I've actually not thought that through.
I'll send it over to you. There's a bit of a minimum investment on the pref equity side.
Okay.
It's higher minimum, but then it allows you to make that minimum investment. Let's say the minimum investment is 250,000 on the pref equity side, which not guarantee, but has that 9% pref per se, and then on the common equity is 25,000. So it's a big difference. But then now so people can kind of mix it up between both types of classes of investments that exist. Yeah.
I will say this, like I thought about it a little bit as you were talking, and I think that if the world came to the point where it was only 2 classes, shares and apartments that I can invest in, I'd probably end up doing both, to your point, because that would be a better solution for me. But I think if I can only get the common equity still, I'd probably still go with that, because I still end up getting, to me, it just won't make up for the risk reward of not getting the upside when the risk is already low.